Hey guys, Candlesticks here. Welcome back to the channel. Today I have another walkthrough and another example of how we use technical analysis to find high probability trading opportunities in the market. Today's video is going to focus specifically on, and let's hop in. We got a cool trading opportunity to start off with today. Gregory mentioned it in the main chat, and I'm going to add a little bit more to it. And it's going to be cool because two things. One, it follows up on the conversation that we had yesterday, right? If you guys remember yesterday, we started with a question about pretty much multiple time frame analysis, higher time frame analysis, lower time frame analysis. How do you combine the two? How do you use what for which and which for what and all that fun stuff? This shows kind of an example of how the higher time frame analysis can play a role with the smaller time frame or lower time frame analysis, how it works together. And it's also a follow-up on an opportunity that we thought we had yesterday that never came to fruition, and now we have to adjust our analysis. And it's a good example of how, as traders, we need to be soulless mercenaries who don't get emotionally invested in one side of the market or the other. We just trade for our personal I don't know. We trade for our personal relevance, personal money. We trade to make ourselves money. That's what we don't really care about direction. We're going to start here on the dollar yen for you guys that want to follow along. And if you remember on the 4-hour chart of the dollar yen, yesterday we had our CPI news came out, and we were looking for a retest of this level. I had two levels drawn. I said, hey, we have level number one, uno, right here. We had a lower level, which I always say, right? Be aware of over and underlapping structure because it is the more powerful level and you don't want to get skunked out of your stop losses. We had that right down here, dos, right? And you can see price action came down to that level. We were looking for a potential bullish structure-based trade. You guys remember this from yesterday? Right? It would have been right around here. We were looking for a retest of structure, a hold of structure, and a potential trade. We didn't know if we were going to get the risk reward to work, but a potential trade back up to this area. At least that's what I was looking for, right? And everything worked out for the most part, right? We had a high momentum bearish move down there, right? 1, 2, 3, 4, 5 straight strong high momentum bear candles down there. It looked as if we were getting another bearish candle down there. We went to that level. We went past that level. And then it kind of got sucked up. Now, for you guys that are familiar with, if you've been to the part of the course where we talk about different type of candlestick strengths and stuff like that and creating a story off of it, how would you classify this green candle? Is that a positive sign for the bears? A positive sign for the bulls? What would you say? As you're reading the market, we dive down into structure. We get that green candle. Is that bull positive? Is that bear positive? Any thoughts there? Right. That is a positive sign for the bulls, for the buyers, right? It is a bullish candle. It has a long wick to the downside, which means that price pushed down to that level and it was rejected. And it closed, it did not close beyond structure. So a very positive sign. Now, for me, right, this, this would retrace too far to be a trading opportunity anyway. But for me, I need a 3-bar reversal. So what I need after that for confirmation is a higher high, higher close, right? So that next bar needs to break above and close above that green bar. And you can see we did not do it. We kind of had an inside bar, which is kind of indecision, the pause. And then we slammed down on a secondary wave from the CPI report and broke and closed below. Now, once we have the break and close below, are we still looking for bullish opportunities at this level, or has this level of previous structure support been violated and invalidated? Well, once we have that break and close below, it has been violated, it has been invalidated. We are no longer, or I am no longer looking for short opportunities, right? These are called decision points. And we restart the IPDE process, right? So now when we identify, instead of saying, I identify price being at a previous level of structure support, and if we hold, then I'll look for a buying opportunity. Now the narrative changes to, well, what do I identify? I identify a break and close below structure. A break and close below structure allows me to predict that price is likely to go which way? Up or down? What would you guys say? The basic rules of IPDE. If we break and close below, our prediction is that we're likely to continue down. Yeah, okay. So again, it shifts our narrative. And this is what I was talking about, where you don't want to fall in love with your trades. You know, so many traders take trading personally, where it's like, it's not, they do analysis and it's not just an idea, but it's their idea, and they're married to their idea, and their idea is this ship. It is the Titanic, and it hits an iceberg, and they have to go down with that idea. No, jump off. Save yourself. There's another boat right next to you. Jump on that next boat. You don't need to go down with the ship. But it becomes an ego and a pride thing, where it's like, I can't be wrong in my analysis, because if I'm wrong in my analysis, I'm a bad person. And I'm sure we reflect in ways like that. The best advice I can give you long-term in your trading, it's going to sound weird, but like, get comfortable being wrong. I mean, we're no different than weathermen, right? We're going to be wrong all the time. I am wrong nearly half the time, right? It's okay, right? Find the opportunity where you're right. So you don't get, you know, but again, we see this all the time, where like it'll close below, and I'll get, you know, messages from people, hey, Gil, I'm still looking to get long. I'm like, why? Well, because I was looking to get long yesterday. I'm like, well, is the market the same as it was yesterday? No, but it just has to happen because I put it out there, and now I'm going to look like an idiot if I change my opinion. Like, well, okay, well, do you care about the money, baby? Or do you care about what other people think? Well, what other people think? All right, well, you probably shouldn't be a trader. Like, but I seriously get questions like that. It's a pride thing. So let's hurry this on before the trading opportunity is gone. But so now we change our prediction. So we saw the break and close below structure. So now the next question is, if we continue lower, where is price action likely to go lower to, right? Well, we have a few levels that we can look at, right? We'll just kind of do the basic ebbs and flows of price action. Again, I don't know which is which. Ebb, flow, flow, ebb, flow, ebb, flow, ebb, flow, ebb, right? And then flow, right? So our next most recent, if I said that the right way, kill zone is right here. This level right here, right? A previous structure high, a previous outside return, right? Basics 101. Another level to pay attention to is this, however, right in here, this little pregnant pause. I forgot who asked about this yesterday. I don't remember. I think it was Muse. This little pregnant pause. Again, this breakout, right? Essentially, and you'll see this on a lower time frame. If you look at how these candles are distributed, right? We have this big green candle. This is, imagine a big bull trend like that. We have our consolidation sideways, followed by another breakout. This is essentially a high and tight flag, right? It's kind of consolidation like this, and then another breakout, right? So think about it as like a structure shelf on your lower time frame. So those are the two levels that stand out to me, right? We can also bring some volume into the equation if you're like, man, well, I don't know, which do I choose? Is one more important than the other? Because this is a pretty big range, right? The range goes from 54.85 down to 53 flat, so about 180 pips. Let's bring our volume profile in here and see if anything stands out. Well, we have lots of volume up here, and then we have a little bit of, hold on. Do, re, mi, fa, sol, la, ti, do. We have a little bit of the void. Oh, man, I didn't have the right. Hold on, rewind. We have a little bit of the void right here. I've ruined it. I'm sorry. It was, I did everything right. I got the vocals all revved up, and I didn't push the button. We'll just, can you edit out live stuff? Can I just, where's my little Men in Black thing that erases your memory? Or for you guys who have been watching Travelers, we're on season 3 now, a little thing they poke into your neck that makes you forget things. Wish I would have had some of those in college, I'll tell you what. But that's another story for another day. Anyway, the void here is, again, I always say to kind of a volume for dummies, higher volume, higher interest, lower volume, lower interest, Think about higher volume as being like, we call it rush hour here in the States. It's like when everyone's driving home, because we all drive, and the roads are crowded and you can't get anywhere because it's busy. Think about the void right here being like you're driving in the middle of the night because you've made some bad decisions and there's no one on the road, so you can kind of drive freer. So where volume picks up is typically where there's more interest in the market. So this is something that can help you kind of pinpoint, well, where is the area that has more interest versus the area that has less interest, right? So you could look at a conservative level, maybe right here at 154.90s. But if you want to be more aggressive, you can probably aim all the way down, I think Alex said this earlier, for about 154. Once again, I can do the void. Is that better? Here we go. The void. All right. So we have that higher time frame analysis for a potential trend continuation trade, right? And we kind of know what levels we're shooting for. We go down to the lower time frame and things get a little cool here, right? Because we have a few things happening, right? We had our break and close. I'm going to delete, delete our stuff here. Give us a fresh chart. We had our break and close here, right? Here was our move down, zoop, and then our move up, zap, and then our break and close below here, and then this was our pullback, right? This would have been a nice entry right here. For you guys that were up at 3 o'clock in the morning my time, which is 8 o'clock in the morning for many of you guys, this would have been a nice lower low, lower close entry right here. This would have been something I would be certainly interested in. I wouldn't be able to get the risk reward to work because of my counter trend trading ways, but I think this is a good entry right here. It looks like we're either going to retest that or we may put in some type of complex pullback. Now, do you guys know what a complex pullback is? Does anyone not know what a complex pullback is? And again, this is not the place to be shy. You don't have to be like, no one else is raising their hand, so I'm not going to do it either. This is where we learn. So if you don't know, allow me to teach you. I just want to get a read of the room, because I know we're all on different levels here. And no one's on my level, of course, but we're all on different levels below me, the master, of course. So a complex pullback is a multiple leg pullback. So think about it like this. Usually the market goes like this. It trends and you see these little things, right? Extensions, retracements, right? Extensions, retracements, extensions long, retracements short. So in beautiful written textbooks and picture perfect examples, we draw it like this because it's the most simplest way to explain. Unfortunately, the market doesn't always do this. Sometimes these retracements have multiple legs in them or multiple waves, right? And they look like this. So we call it a complex pullback when a retracement has multiple waves. So it has multiple ebbs and flows. It's still a retracement, right? Because it's still pulling back from our new structure low back into our previous extension. But it can do it like this. It can do it like this. So we call it complex pullback. It's more than one moves. What gets things freaky is like on lower time frames, those are actually full blown opposite trends in their own direction, and that's how the market gets weird, because then you can be looking at like an hourly and be like, this is a bearish trend, but then you go to a 4 hour and be like, oh, that bearish trend on the hourly is only a pullback on the 4 hour, but then that pullback on the 4 hour is only a retracement on the daily, and it goes on forever. It's like space in the universe if you get weird like that, where it's like, let's not go there. But a multiple leg pullback. So if this were to continue up past this high, this would be a complex pullback, right? As long as we don't violate our previous outside return, which is right here. Now, this complex pullback, potential complex pullback, happens to also be something else, right? If we take this thing and I just write out the letter X, we have an idea of what this might be, right? Swing high to swing low. This could be an X to A. Right down here. We see the retracement comes up to our 618 Fibonacci retracement. Coming up to a 618 puts us on alert for a Gartley pattern, right? Our B leg's going to be right here. We hit another 618. On our failed extension down, this would be our C leg. I'll connect all the dots later, I promise. And if we rally up, again, the way I trade Gartleys, to the 127 extension, nice and high here, if we rally up to this level or this zone, this is going to be the decompletion for a Gartley pattern. So X to A to B, B to C, and C to D, right? So in this particular instance, and you see this in many cases, this is kind of the brilliance of patterns, this complex pullback is also a Gartley pattern or a potential advanced pattern formation. So this is a bearish pattern. Do I have a bear? I do. Grr, right? This is a bearish pattern, which means we're looking for shorts. As always with Gartleys, right? If you're using traditional targets, Fibonacci retracement from our A leg to our D completion, wherever that may be, your traditional target is going to be, again, your 382 for target 1. It would be your 618 for target 2. But what other information do we have about this trade or this pair? I'll give you a clue. This is very similar to what we did in the Trading Edge video 2 weeks ago. I believe it was on New Zealand, Canada. What information did we first gauge from our higher time frame where we climbed the cliff and we just made observations, not looking to trade, but just wanted to see what the market is doing? Are we in consolidation like most advanced patterns, or do we happen to be in a bigger trend continuation mode? Well, remember, we said that we were in a bigger trend continuation mode, right? We saw opportunity all the way down to, I would say, 155 at the most conservative. And then 154, I wouldn't say the most aggressive, but 154 is an aggressive level for it. Well, this is an opportunity where, if you'd like, and of course if you're allowed, right, a chance to use this, or well, let's not go there yet. A chance to look for bigger potential profits that go down to these levels. And the way I like to say it is you can look at this in 3 ways, or trade this in 3 ways, right? One, you can use the Gartley as simply an entry reason into your trend continuation trade. So if you're a trend continuation trader on the higher time frame and you went down to your lower time frame to decide, right? IPDE, decide is the D, decide how you want to execute the trade, E. And, you know, this would be no different than like, well, I enter on a double top or I enter on a lower low, lower close. If you're allowed to enter on an advanced pattern, this gives you an aggressive way to enter because you can just put a limit order there and boom, you're in. So it can simply be, the Gartley can simply be an entry to your trend continuation trade. That's scenario 1. Scenario 2, this is just simply a Gartley, right? You say, Akil, I'm not a trend continuation trader. I don't use higher time frames. I just find these little pattern guys and I trade them. All right, yeah. Well, trade it as a normal Gartley. And then 3 is a combination of both. Maybe you trade it as a Gartley, perhaps take half position off at a normal traditional Gartley target, whatever that is for you. But instead of having your secondary target where it usually is, you allow your secondary target to be, as Lynn said, extended for the bigger trend continuation play. So those are the 3 different ways you can handle this scenario. Now, I want to dig in. I want to get back to Gary's question at some point, but I want to dig into kind of looking for also some ways to kind of look at these secondary targets. One would be taking a Fibonacci extension from, we had volume out already, although I erased it, from our X leg to our A leg, and seeing if there's any confluence here, and back up, of course. We're going to see that there's a 120, there's a 113 right at our 155 level. But there's a 127 a little bit lower. There's a 1618 right above 54s, right above 154 even. I also want to go, well, we'll just go to, the 4-hour time frame. And I want to take a Fibonacci extension from this full leg, right? This full swing down. This is the swing, right? From up here to down here. I want to see if there's any confluence at these levels. And boom, you'll see a little bit of a 127 right above that level. So I would say for secondary targets, maybe instead of shooting for 154, if you're Fib based, whatever like that, maybe shoot a little bit higher, like 154.35s or something like that, or 154, somewhere between this 127 and that 1618 level. So different ways to skin a cat. I don't know, different ways to skin a cat. Different ways to look for potential profits here, but a good example of, again, combining, following up on yesterday's conversation about combining higher time frame and lower time frame, using what for what, and how one can influence the other. Now we'll take questions on it. Hope you enjoyed the vid. This was taken from our live trading room. If you ever want to join, we have both a London session and a New York session that we host 3 days a week. Head over to tier1trading.com and get started today. All right, until next time, plan your trade, trade your plan. Take care.
I wanna be the best in the game, invest in my name, check no restraints, I'm obsessed with the pain, I ingest, I retain, assess and I change, possessed by the thought I'll be free one day from society's restraints, money, clout and fame, mud, disease, a plague, we all love to hate, have to play the game, have to make a name, all our insecurities are on display.